Jump risk and options. That's the topic on the Traders Workshop today. I'm your host, Lex, and this is The Brew. Good. What's up, boys? How are you?
What's going on, Lex? How you doing?
You know, another week in the bag here, getting close. I got a big vacation coming up, so I'm
I
excited.
was about to say, getting close.
Yeah, getting close to the vacation.
A week full of upticks here.
Yeah, right. Hey, by the way, did you notice that the market's up?
Is it?
It's up every day. I'm being a smartass, but Mark, I can't remember the last time in my career that I've seen this much bullishness consecutively. It's just like you can't keep a good sell-off down.
You traded through the tech bubble. You traded through post-COVID. You traded.
Yeah, I traded through when the Dow Jones was about $600. So yeah.
It is. It's quite the turnaround. We had a head fake the first week of this year, but it's nope. The bull train's continuing.
Yeah, it's amazing. I've got to roll up all my short spreads because I am sort of bearish, I'd say, midterm bearish. So I'm trying to put on some gallywags in the Qs and even Apple for that matter. Don't follow what I'm doing because gosh darn, I've been wrong for a home run. I'm trying to roll it up now. But yeah, we're gonna get it. You know, when I get long, that's when we're gonna get the sell off. What are we talking about?
I feel you on that. I feel you.
Yeah, right. We're talking about jump risk today, right? And maybe the fact that I should do something with this. So I've gotten bitten by jump. Well, first of all, let's define jump risk. What do you guys think it means? What does this term mean? Anyone? Bueller? Anyone?
Okay. Go ahead, Mark.
It's when price jumps or vol jumps or there's discontinuity in the hedgeability of some asset.
Yeah, right. So and if it happens intraday, you're there for it. It's could be from a supply demand issue if volatility jumps, but I always refer to jump risk as something that happens overnight. So it's from the close of the previous day to the opening of today.
That's gap risk.
That's gap risk, but I call it jump risk too. And the reason I call it that is because for the same reason, you can't trade a gap typically. Now, I know there's after hours sort of things that you can do, but not all the options are open, in the middle. For Mark and I, when we were in the trading business, it was the best event when you're long gamma, right? Oh my God.
Thumbs up frozen.
It's a stupid Apple thing. It's a Mac thing. So I'm keeping my hands below now. So it was it didn't go ahead. Sorry, Jason.
Oh no, I was just gonna say the definition that I always hear of jump risk is 2 standard deviation move in the underlying, over a certain time frame.
Yeah, that's very technical.
Yeah.
I always consider jump risk to be anything that either helps me or hurts me severely, no matter how big the move was.
You define jump risk emotionally.
I define it emotionally. But my point was going to be that for options traders, especially the long gamma version of this, a jump is the best because you don't have any ability to screw this up with scalps, gamma hedges in between the jump, right? Mm-hmm. So it's a beautiful thing with long gamma when you get a big enough jump, right, Mark?
Absolutely. And I do want to have a little qualification. I think gap risk can happen intraday if a stock halts.
Yeah, absolutely. Especially
that's the scenario. It's like anytime there's an untradable period. Usually that's overnight, but it absolutely can happen if you hit a circuit breaker or short sale, uptick rule scenario.
Yep. Yeah. We've seen that in our path in the industry. I mean, I saw that in 2008 to the downside. That was one of the more frightening days, I think, that monster sell-off I've ever experienced. That was terrifying. I mean, honestly, that day I thought I remember calling my dad. He's in the industry, right? And I said, "Man, is the world coming to an end? This looks utterly horrible. There is nothing out there. There's no liquidity, no bid, no nothing." I mean, it was horrible, right?
Did you trade in 87?
I traded in 87 too. I made that crash as well. I also made the 1930 depression. I was there for that.
Were you there for the fall of the Roman Empire?
I was there for that as well. That's how old I am. All right. Is there any way to shield yourself from this overnight risk? Now I brought this up to you guys a while back relative to zero DTE. And I posited the thought that I like to put on a trade for tomorrow's zero DTE today. And you guys said, well, what there you have to factor in jump risk now, or whatever you call it, gap risk, let's call it. I said, yeah, but it looks like overnight volatility in the SPX is like 7 or 6, something very low, and implied volatility in these options is probably 15, 16, 17. Is it worth taking? And you guys said what?
Not really. No.
Okay.
And the reason why is because ultimately, I think, first of all, the overnight period is priced in. There is like a time phasing priced in to the options. Like, when we see at the end of the day how at 3:45 and on, markets get more volatile, the options price that in. So that overnight gap risk is priced as lesser volatility. And because obviously you can't trade it. But then if there is a gap, there's some kind of data reading or something like that, that options aren't accounting for, then your iron butterfly is toast. Or some earnings report, earnings are very infrequently priced into SPX or XSP options. And we talked about that last week, how dispersion vol is so much higher than index vol because the index doesn't account as much for earnings. So ultimately, I think that trading the 1 DTE is more risky than rewarding.
Okay. Overnight. Because jump risk, I think, is, like Mark said, even with dealers, that's their biggest risk is jump risk or gap risk. Okay. Fair enough.
It's a strong move that they can't hedge right away.
Yeah. Don't forget, if you're a dealer, though, you naturally have overnight risk anyway. Because you're not flat positions, you have positions all the way out in the term structure, right?
Yep.
You as an entity, you naturally have that, right? Now you can certainly manage, gamma and all that stuff so that the risk is really non-existent, I suppose. On the retail side, though, people make trading decisions and put on positions for a reason, right? So they don't have the ability, like a market making firm, to really hedge that continuously as much as we think they do. So I guess I'll pose this to you, Mark. Tell me what you think. There's got to be some number where jump risk makes sense, or at least assuming it, overnight risk makes sense, right? So if realized jump risk is 6 vol and implied of the SPX options is 17, maybe that's not enough. What is enough? Is 34 enough? Is 26 enough? It seems to be scary because the higher implied goes, it means that things are really moving around. And are they moving around just intraday, or are we getting these big gaps every day that also contributes to some of that implied volatility expansion? There's a lot there. Sorry.
Wow. Yeah. No, I think I want to start with one of the things you did say about like the overnight risk versus the intraday risk. Like one of the curiosities of the 24-hour session is that there really isn't SPX overnight risk. There's weekend risk, but like from Sunday at 9 o'clock or maybe it's early Monday morning at 2 a.m. I forgot what time they open on Monday, but you basically have 5 continuous days of trading with all but 15-minute breaks in between. So SPX,
the options, right?
Including the options and VIX, both SPX and VIX have overnight activity. So like in those liquid markets, like your jump risk is really been reduced to almost nothing. There is a continuously traded element there,
right?
Which probably serves to lower the overnight vol, right? To the extent that there's more jump risk uncertainty, you need to raise the price of volatility. As far as like maybe one of your things about managing jump risk, and like, I think the way dealers think about it is like, you set up a matrix. Like, what happens if stock goes here and vol goes here? How much money do I make in each of those little quadrants, or lose in each of those quadrants? And you want those numbers to be commensurate with the amount of edge that you're collecting trading that product. So you can bear a certain amount of jump risk, commensurate with the amount of revenue you've generated from collecting edge and putting on that position.
Right.
If you haven't been trading something very long, you're not making money in this product, you don't want a lot of jump risk, because but if something's been, very liquid, a lot of turnover, you can bear to have more and more of that risk because there's been liquidity in action.
Okay. Is there anything in Volin that talks about this, Jason? Anything yet? Or is there anything
nothing about jump risk? I mean, I actually, the whole overnight SPX trading is relatively new, right? Like,
yes.
I completely. Are those markets liquid, Mark?
They're not bad. I think they added SPX Global
I
Hours.
haven't traded it.
That's because. Yeah, go ahead. Sorry.
I'm trying to figure out when they added them. I was still a market maker when they did it. I think it was like 2017 or 18.
Okay.
Oh, okay.
Yeah, but now the term is much longer, and I can't remember what it is. So SPX closes at 3, or they market at 3, right? And then isn't there a halt of sorts where it's closed for a little bit and then it reopens at some time, maybe a half hour later, and then it trades all the way through the night. It's got to close again for the morning opening, right?
Okay, so Chicago time, it goes 7:15 p.m. to 8:15 a.m. and then there's a 15-minute break in the morning where from 8:15 to 8:30 nothing's open. Then 8:30 SIBO time they open again, and this says that from 3 to 7 they're closed. I honestly thought they were open in that time.
Yeah, me too.
But it might not. It looks like they might not open at 7 p.m. again.
Okay, well that makes sense. So then that's when the night session starts. Yeah. And although I've made trades after 3:30 or 4 o'clock, that obviously in the 0DT that expired that day, that's dead. That one's done. But the subsequent one expirations, I seem to remember getting trades in those and getting fills. I'm going to
have a curb session in SPX VIX and SXP that goes until 3:15 to 4 o'clock Chicago time.
Got it. That's what I was looking for. There's a curb session, right? Okay, and then the real trading of the extended hours starts at 7.
Doesn't start until 7, exactly.
Gotcha. Okay, so and technically, then if I can get out of something I put on at the end of the trading day, I can. It sounds like I can trade it during either curb or the extended session. Maybe not as great liquidity. So you guys might be right. Maybe gap risk isn't as prevalent as we think. So.
And I think.
No, he's there. Mark, you frozen? Wiggle your eyebrow. No, he's frozen.
Definitely frozen then.
He's got that frozen.
Wiggle your big toe.
I'm throwing thumbs up everywhere over here.
Yeah, we can hear you though. So go ahead.
The other interesting thing about gap risk or jump risk or however you want to call it is that it's the foundation of like the portfolio margining system or the CME span system.
Yep.
That like it's not just like, hey, manage risk, know what's going to happen. If like literally the amount of capital you have to put in place is based entirely on measuring jumps and how much you make or lose in those scenarios.
Yeah, so that's a good point. We're going to be doing portfolio margin at Tradier very soon. We're finally getting there, my God. But the way they measure with that portfolio margin, right, Mark? I can't remember the slices, but let's just say it's like 10%, 15, 30 up and down with volatility, implied volatility shocks built into that calculation. And wherever you have the most amount of risk is your haircut.
Yep. For
that position. And it's a global position. So it's everything in your portfolio. So they shock it up and down like that, right? And if you have the most risk at 10%, but you have, some calls that you're long or puts that you're long at 15% and it covers you, you're going to get that margin number at the 10% number, right? And if everything looks like you make money on all those different scenarios, then you're charged $25 a contract, at least at the pro level. I don't know what retail would be charged.
I don't. That's definitely the pro level. I don't know what it is from an individual level.
Yep.
But yeah, the CME has like 16 different scenarios for their span margin.
Right.
And like there can be crazy scenarios, right? Like we used to have those arguments that like, well, how can stock rip and, vol also rip up? Like, vol doesn't double and stock, is up 10%.
Right.
But if that's your worst of matrix, like you got to have that.
Yeah. I wonder if they've changed it a little bit to say stock up, let's say 10%, vol down pretty handily, like an earnings sort of thing. I wonder if they look at that now.
I think they look at all it's just a matrix, right? Like there can even be unreasonable scenarios for what spot and vol should do. But you're on the hook for it.
Right. Okay. Yeah. So I think from this discussion, it sounds like we've determined that gap risk really isn't much of a deal in SPX. Should I go back to read my newspaper?
Well, I guess so, but I think that's still that theta that you're getting overnight, that you're trying to get from your iron butterfly is not, the juice isn't worth the squeeze. Well, that's kind of what I found, but that's just, I think it's because of less liquid markets. I mean, there is a lot more trading, at least even in the ES, during market hours than there are overnight.
Okay.
And so that's kind of why I don't know the liquidity. I guess it's not bad liquidity overnight. I always just kind of just said, I'm not trading overnight, at market hours.
Right.
I do know that SPX had extended sessions, but I also knew that they had wider spreads. So I didn't bother with it as much.
Mm-hmm.
But yeah, I mean, personally, I consider jump risk, but I also I trade more in a swing time frame as opposed to 0 DTE. But I guess you're trading right now, right?
Did you hear the ding?
I did hear the ding.
Yeah, I'm looking at Volland. I'm saying that we're going to get a little bit of a pullback, and I'm taking advantage of.
Okay. So wait a minute. When you looked at Volland 0 DTE, what are you saying pullback from?
I'm saying that this guy named Jason, he sent me a text and said, here's a good spot.
I did not send you a text today. Look, man. Look, yesterday, because some people were getting confused because it's like very high positive vega for dealers.
Yep.
But people were trading it in day trading. I'm like, wait, no. We had our 6 day trading Volland commandments.
Okay, give me a good one.
So here's the one that's pertinent right now. Never short a Jex paradigm above the line in the sand.
Okay.
Never short.
And today is a Jex paradigm with the line in the sand.
Today's a Jex paradigm, and we are above the line in the sand.
So don't short it here. We're going higher.
Never short. You can be flat, you can be bullish, but never short.
Son of a God. Well, I'm short it now.
Oh man, Jason froze just as he was about to give a recommendation here. I think compliance cut his cord.
Never. So we're in a Jex pair, and your data shows, and this is your opinion, that we're screaming higher.
Well, my data shows that the 0 DTE outlook is more bullish than anything. I'm not saying we're going to scream higher. Maybe, I think there's like a treasure, yesterday we reversed lower on a treasury auction. Today's another treasury auction, and that can happen. But never short a Jex paradigm, at least when it's above the line in the sand. So
what if it goes back below the line in the sand?
Then you can short.
Then I can short.
Yes.
All right.
Line in the sand today is, I freeze because I'm going back and forth to Volland.
Okay.
Line in the sand today looks like it's between 48.65 and 48.70.
Well, we're already way beyond that.
Down?
No, up. It's 40.
No, down. Line in the sand is down. Targets are up.
But okay,
the target is 49.10.
49.10 today. Okay, yep. I'm still safe up there.
Yeah, it'll probably hang up there at 4,900, but 4,900, 49.10 is the
Can I short it at 4,900?
Yes.
Not a recommendation. I get it. Not a recommendation. I'm with you. Okay. All right. I'm cooked. All right.
Those are the commandments.
Those are the commandments. I got you.
Yeah.
I got it now. And the other commandment sounds like the other commandment relative to jump risk or gap risk is There is no such thing, so don't worry about it.
Well, this is 0 DTE day trading, so there is no jump risk.
Yeah.
The other ones are if there's a paradigm shift, get out of your position. If there's an anti-jex paradigm, do not long an anti-jex paradigm ever.
Right. Okay.
What are my other commandments?
There's a lot.
Again, you have to go into my Discord.
I know. I have 7. I have 7 commandments, but we're not going to go over them now. We'll do that another time. Oh, wait. What was that?
Geez.
Guess what that was? I just closed the double diagonal.
Oh, well, that's good. That's closing. Was it profit?
Of course. I wouldn't be closing it otherwise. Good golly.
So no stops.
No
stop flex.
No stops. Not with a double diagonal. No. Yeah. No. I know what I can lose. I don't need to stop.
Okay.
Yeah. All right, Mark, you still here?
I am. I'm listening to your commandments.
All right. Give us one last little tidbit on gap risk or jump risk. Anything. What do you think? It sounds like we should have even talked about this dumb idea. There is, because it doesn't exist.
Well, what do you think of the 1 DTE versus 0 DTE iron butterfly?
Is that Mark? Yeah. Go ahead, Mark.
Well, one's longer than the other. I don't understand the question.
Do you think Lex is better off doing 1 DTE or 0 DTE? Do you think having that overnight decay is worth it for 0 DTE?
Oh, yes. I think that the overnight session is undervalued. And that like you're selling premium too cheap for the amount of variance that occurs in the overnight session. So I think I'd rather sell something with 6 hours to expiration than something with 20 hours to expiration. Yeah.
Or, and extrapolating, I'd rather sell something, as you said, with 3 days to expiration than 30 days, or 30 days versus 300 days. Right.
And like I measure this with like Parkinson's historical vol versus close to close historical vols, and like how much is it moving high to low within the trading session versus how much is it moving just close to close, and close to close is almost always higher than intraday historical volatility.
Yeah. Mm-hmm. Yep. That's a good point. I think that's why these 0 DTs have gained so much popularity, because as a retail person, they can come in here day of T-0, trade it up for 6 hours. They probably don't even use 6 hours. They probably do it within the last 3, and they're done. They know the solution at the end of 3 hours, right? So very manageable.
The other thing too, though, even though it's undervalued, it's still not. I wouldn't now start buying strangles or straddles or anything, because then your path to profitability is pretty low too. So it's kind of. I think they are well priced. So that's kind of why I don't, if I am doing day trading, which, I don't really right now, but if I did, I would not be, trying to pick up that overnight.
Yeah. So having said all this, though, it may beg the question, well, if you don't think volatility is priced too high, is it priced perfectly or is it too low? And if it's too low, then should we be buying jump risk or gap risk? So, straddle, strangle, whatever, selling the butterfly for overnight.
I think it has been well priced.
Yeah.
Okay.
So it's like priced too low compared to historical volatility.
Yep.
But when you actually try to, because, probably a couple months ago, but when you actually try to implement taking advantage of that,
yep.
The success rate is moderate, but your reward is not worth the price that you're paying.
Yeah. Okay. Fair enough. All right, boys. Sounds good. What else? Mark, you good? Are you still? I like Mark being frozen up there. It's awesome.
Oh, you can't see all my thumbs up and hand motions and me saying sold whenever Lex says something.
That's right, sold.
Well, this is the second week that Mark has been frozen in one spot for the whole show. So I think, Mark, it's a good idea if you just like kind of give a goofy face the whole time, just until you get frozen, and then you can,
I should just put
it now. It looks like you're studious.
I'm going to leave you with one other thought. Maybe we tackle this next week. Jump risk. I'm back to this jump risk thing. What about the calendar or the diagonal or the double diagonal? So overnight, at the end of day 0 today, you do the next day and then day after that as a calendar, double calendar, double diagonal.
I
And
like the double calendar, the overnight double calendar.
I love that too, because now you get to take advantage of jumpers, assuming you place it at an expected move ish right around there on both sides.
So yeah, I mean that's kind of that move I like a lot better, because if you put the double calendar at the expected move, and even if it falls outside, or if you get some jump risk and you go outside your long strikes, you're making money. If not, the next day, right in the morning, you can sell that midpoint, and all of a sudden you got yourself an iron butterfly for 0 DTE.
Yeah,
and you're getting double premium there.
Right.
But
right. Yep. No, that's a good point. Yeah, I've been playing around with that a lot. It's I noticed that those double calendars, double diagonals, they don't really get crushed, even if you don't get the move that you want too badly. It's a little bit, but not badly. And then, yesterday I got out of it ultimately for something pretty good, but we ended up settling near my short strike in the front term. And that spread, I kept the spread, on in strategies just to see what would happen. That spread went from, I think I bought it for the double for like $4, let's say $4.50. And it closed at like 10. Something goofy, or maybe 8, I forget, but it was really a big number. But again, it was very lucky to go to that strike, right?
Yeah.
So anywho, all right, we'll talk about the next week. You guys have a good weekend. Good to talk to you. Think about OIC. It should be fun.
All right, think about
fun and expensive, but all right, Mark. Have a good weekend, boys.
All right, happy trading, everyone.
Happy trading.